Imagine you're marketing a financial product to a small business owner,
Right.
right? And they have a 500 credit score.
Yeah, that's usually a pretty tough spot to be in.
Exactly. I mean,
Yeah.
you know full well that a traditional commercial bank would just laugh them straight out of the lobby.
Oh, absolutely. They wouldn't even get past the front desk.
Right. So the natural instinct is to just toss that lead in the trash. But today, we're diving into why sending that exact, seemingly unbankable lead to alternative lenders like ROK Financial or Lexington Capital Holdings isn't just possible. It's actually an incredibly profitable strategy for a referral partner.
It really is. I mean, it completely flips the traditional banking model on its head. The leads that used to be considered total liabilities are now, well, they're viable assets, provided you route them through the correct infrastructure.
And that infrastructure is exactly what we're focusing on for this deep dive. So our sources today are the official digital footprints of both Lexington Capital Holdings and RK Financial.
Both major players in the space.
Huge players. And both of these platforms prominently feature like partner and affiliate programs right in their main navigation.
Yeah.
They actively court people to send them leads.
Yeah, they want your business.
Right. But if you look closely at these portals, they spend most of their real estate explaining the technical steps to sign up. Like they don't really outline the back-end leverage you actually get when you partner with them.
Right. They outline the software integration, the dashboard access, but they assume you already understand the underlying market mechanics, which a lot of people don't.
Exactly. So our mission today is to extract the actual ground-level advantages of working with ROK and Lexington from an affiliate's perspective. Because, I mean, a shiny partner dashboard means absolutely nothing if the company you're referring your clients to can't actually close the deal.
Yeah, it's useless.
Totally. The ultimate affiliate perk is the product arsenal, the accessibility of the capital, and, the lender's reputation.
What's fascinating here is that while both of these companies operate in the exact same alternative finance space, their websites reveal slightly different strategic advantages.
Huh.
Yeah, so an astute affiliate could leverage their distinct structural models depending entirely on the specific, friction points their clients are facing.
Well, let's start with the most obvious point of friction, which is the menu. For an affiliate, there is literally nothing worse than spending time and marketing budget to acquire a highly motivated lead, getting them to trust you, sending them to your lending partner,
And having the lender reject them.
yes, having the lender reject them simply because they don't carry the specific financial instrument the business needs.
It's the equivalent of a retail store having empty shelves. The customer is standing there ready to buy, but you have nothing to sell them. In the affiliate ecosystem, a limited product menu translates directly to a capped conversion rate.
Right. But looking at the sheer scale of ROK Financial in our sources, their shelves are fully stocked. I mean, they list term loans and business lines of credit ranging from $10,000 all the way up to a staggering $5 million.
Which is a massive spread.
It is. But they don't stop at standard loans. They specifically highlight accounts receivable and purchase order financing.
Oh, right.
Yeah. And the sources note this is tailored for invoices of $100,000 or more, aged up to 90 days. They also offer commercial real estate loans stretching from $250,000 up to $10 million.
Wow.
Plus, franchise financing, startup funding, middle market lending. It's just huge.
And the inclusion of accounts receivable financing for invoices aged up to 90 days is a critical detail for an affiliate to understand.
Really? Why the 90 days specifically?
Well, traditional commercial banks typically will not touch receivables that have aged past 60 days.
Oh, because it's too risky.
Exactly. The statistical probability of default spikes after 60 days. So by extending that window to 90 days, ROK is allowing an affiliate to monetize a B2B business that is asset-rich in pending invoices, but temporarily starved for operating cash.
Wow, that is a massive demographic of small businesses. And then, you look at Lexington Capital Holdings, and they approach their menu with a slightly different signature product.
Right, the LexLock.
Yeah, the sources highlight something they brand as the LexLock. They specifically call this out as their most popular option. It's basically a revolving business line of credit where the business owner can draw cash on an as-needed basis, but, and this is the key mechanism, they only pay interest on the capital they actively use.
Which functions as a crucial safety net. Think about small businesses or contractors who experience uneven cash flow cycles.
Oh, like landscapers or something.
Exactly. They can secure the line of credit when their financials look strongest, let it sit dormant at zero cost, and deploy it only when they need to, say, bridge a payroll gap or secure raw materials.
Okay, let's unpack this for a second. If I'm an affiliate looking at these two massive menus, I have to worry about the Swiss Army knife problem.
Okay, the Swiss Army knife problem. Explain that.
Well, a Swiss Army knife is super convenient because it has a screwdriver, a saw, a knife, and tweezers all in one handle, right?
Hmm.
But it is rarely the best version of any of those tools.
Fair point.
So if ROK and Lexington are attempting to facilitate everything from a $10,000 startup infusion to a $10 million commercial real estate acquisition, how can their underwriting teams possibly be experts in all those distinct disciplines? Like, doesn't a widened focus dilute their effectiveness?
I see what you're saying. And it would
Yeah.
fundamentally dilute their effectiveness if they were operating like, a local credit union,
Right.
like holding all that paper on a single balance sheet and using one generalist underwriting team. But alternative capital hubs function very differently. They operate essentially as massive syndication networks or routing engines.
Okay, so they're building specialized dedicated lanes for each of those product types within their larger ecosystem.
Precisely. When an affiliate feeds a commercial real estate lead into ROK, it isn't going to the same desk that handles a $10,000 equipment lease.
Oh, that makes sense.
Yeah, it goes to a specialized team that only deals with property appraisals, title work, and commercial amortization schedules. And this structural setup is vital for you, the listener, if you are generating these leads.
Because you don't have to manage it all yourself.
Exactly. It allows you to position your own brand as a comprehensive capital consultant. You don't need to manually build and maintain 10 separate affiliate agreements across 10 niche lenders. You plug into ROK or Lexington, and you let their back-end routing infrastructure do the heavy lifting for you.
You essentially get to be the person who always says, yes, I can handle that, regardless of the complexity of their request.
That's a huge selling point.
But, here is the natural friction point that arises from that. Having an exhaustive menu of products is totally irrelevant if the barrier to entry is too high.
Right. The underwriting metrics are where the alternative finance model historically diverges from traditional banking. And it's really where an affiliate generates their primary value.
So let's look at the actual metrics required to get through the door. Because ROK Financial is incredibly transparent about this on their site.
They lay it all out.
They really do. To qualify for their baseline funding, your client needs just 6 months in business. They need $10,000 in monthly gross sales. And returning to that scenario we opened with, they require only a 500 credit score.
A threshold that would automatically trigger a hard rejection at almost any traditional commercial banking institution in the country.
Right. And here's where it gets really interesting. Traditional banks look at a credit score like a permanent driving record, right? They are heavily indexing the accidents you might have had 3, 4, or 5 years ago.
Yeah, it's very backward looking.
So if ROK is approving a 500 FICO score, I have to assume they're underwriting based on the speedometer, not the permanent record.
That's a great analogy. This raises an important question about risk modeling, and you're entirely correct. The alternative lending space trades historical credit metrics for real-time cash flow velocity.
Wow, cash flow velocity.
Yeah, that requirement of $10,000 in monthly sales is not arbitrary. It's the core collateral.
Because it proves the business has an active heartbeat today.
Yes, exactly. Think about it. If a business owner went through a brutal divorce or medical emergency 3 years ago that tanked their personal credit to 500, a traditional bank algorithm flags them as high risk.
Right, they just see a bad number.
Right. But if that same owner is currently generating $15,000 a month in consistent gross revenue, an alternative lender sees a functioning, healthy organism capable of servicing short-term debt. They are underwriting the current momentum of the business.
And the 6-month time in business requirement also plays into that momentum modeling, I assume. Like, it proves they have survived the initial startup failure window and established some semblance of product market fit.
Exactly. And for an affiliate, understanding this cash flow underwriting mechanism is a game changer. It means you can actively market to and monetize a massive demographic of entrepreneurs who have been repeatedly told no by the traditional financial system.
Wow.
You are no longer just a middleman. You are providing access to a system they didn't even know they could qualify for.
But access is only half of the equation, right? The other half is the speed of execution. I mean, when a business owner goes looking for alternative capital, it is rarely for a project planned 6 months in advance.
Very true. It's usually a fire drill.
Exactly. The transmission on their primary delivery truck just blew, or maybe a competitor is liquidating inventory and they have a 48-hour window to buy it out at a massive discount.
And the timeline of a traditional commercial loan committee simply cannot accommodate the operational speed of modern small business emergencies. They just move too slowly.
Which is why the turnaround times listed in our sources are so critical for an affiliate's conversion rate. ROK explicitly lists their funding speeds: 1 to 3 days for term loans and lines of credit, 2 to 5 days for equipment financing.
That's incredibly fast.
It is. And even their commercial real estate loans, which, are notoriously bogged down by appraisals and environmental studies, they list those at 25 to 40 days.
Which is still light speed for real estate.
Right. And Lexington operates on the exact same high-speed frequency. In the customer reviews for Lexington, there is a direct quote from a client named King Tholices who stated that every task only took 15 minutes, which is ideal for busy entrepreneurs.
Operating in 15-minute task increments removes almost all the friction from the application process.
Yeah, think about the psychology of that for a moment.
Yeah.
If you refer a client to a bank and the process drags out for 6 weeks, that client is calling you every 3 days asking for updates, right? They're getting frustrated, they're experiencing buyer's remorse.
Oh, it's an affiliate's worst nightmare.
But if they get approved based on current revenue and funded in 72 hours, the transaction is closed before they even have time to second-guess the decision.
It completely protects the affiliate's reputation by eliminating that waiting period where doubt usually creeps in.
But wait, that speed introduces a new vulnerability, doesn't it?
How so?
Well, if an underwriter is moving fast enough to fund a challenged credit business in 48 hours, they must be relying heavily on automated algorithms to parse those bank statements. And algorithms inevitably break or misinterpret data.
That's a fair point.
Right. So if an affiliate's client hits a snag in an automated system and gets pushed to a generic customer service queue, they aren't going to be angry at the software. They're going to be angry at the affiliate who sent them there.
That is the ultimate reputational risk. In highly digitized financial environments, the absence of a competent human safety net is usually the primary reason referral partnerships fail.
Which brings us perfectly to the human element highlighted in these sources, specifically the customer reviews for Lexington Capital Holdings. It is, frankly, remarkably rare to see financial service reviews that read with this level of personal gratitude.
What stood out to you?
Well, Lexington currently boasts a 5.0 rating across 1,100 reviews. And these aren't generic auto-generated prompts. Customers are consistently naming their specific representatives.
Which indicates the reps are acting more like dedicated case managers than generic call center employees.
Exactly. The sources show a customer named Eric Street specifically calling out someone named Alec for fast disbursement. Jordan Fiedler and Justin Ott both personally thanked Kevin Nagy for stepping in when no one else could.
Wow.
And the hosts of the Radioactive podcast left a review naming Mark Parolo and Matthew Garcia for helping them navigate a critical time of need.
That's a lot of specific names.
Right. And King Tholices, the reviewer who loved the 15-minute tasks, he actually lists out his entire team: Appio, Carlos, Frank, Chris, and Tyler, and he refers to them collectively as the Get It Done crew.
The Get It Done crew. That is a brilliant branding mechanism, whether it was intentional or totally organic, because it immediately signals to an incoming lead that they are being handed off to a specialized unit, not just a sterile inbox.
And we can see why that specialized unit is structurally necessary when we look at the friction involved in certain products. For example, both companies offer SBA loans.
Oh, it's SBA loan.
Yeah, but as we know, SBA loans are heavily subsidized by the federal government, which means they are buried in federal underwriting requirements. You literally cannot algorithm your way through an SBA application.
No, you absolutely cannot. You need a Sherpa to guide the business owner through the tax document collection, all the personal guarantees, and the compliance checks.
Exactly what Shane Pritchard noted in his review of Lexington. He wrote, "An SBA loan is an exhaustive process. Without the help from the folks at Lexington, I would have never saw it through."
That review right there, if you are an affiliate, that review is gold.
Why is that?
Because it proves that when you send a client into a complex, high-friction environment, the lender has the human infrastructure to prevent that client from abandoning the application out of sheer frustration.
Right, they catch them when they stumble. And ROK Financial exhibits a very similar operational track record. The sources note they have serviced over 25,000 trusted customers. Reviewers like Bob J. and Misky W. both independently use the exact same word, insightful, to describe their finance advisors.
Insightful is a great word for a financial advisor.
It is. Misty specifically stated she would recommend ROK to any small business owner looking to expand. So when your lending partner treats the referred client so well that the client actively begins referring their own network, that creates a compound effect on your initial marketing effort.
It turns one lead into three.
Exactly.
Yeah.
But ROK also arms their affiliates with a distinct competitive advantage that operates totally outside of just the loan terms. They have a highly visible corporate partnership with Feeding America.
Ah, yes. The integration of corporate social responsibility into the B2B lending space.
Yeah. The sources indicate ROK has already provided over 1 million meals to families in need, and they explicitly state that they continue to donate 50 meals for every single successful transaction they fund.
Wow, 50 meals per transaction.
Yeah. And Lexington also leans into this model. They feature a prominent link in their main site navigation to something called the Lexington Foundation.
If we connect this to the bigger picture, alternative lending has historically battled a somewhat predatory or frankly intimidating reputation.
Yeah, definitely.
Business owners often feel like they're stepping into a machine designed solely to extract maximum interest from their operations.
Which is probably why a reviewer named Gary Smith specifically praised his Lexington rep for making him feel, quote, like a friend as opposed to a number.
Precisely. Lexington attacks that sterile reputation through hyper-personalized customer service, while ROK attacks it through quantifiable community impact. For an affiliate, partnering with lenders who prioritize this level of social consciousness provides a massive psychological lever.
Think about how you use that in your marketing copy as a referral partner. If you're trying to convince a skeptical business owner to use your link instead of just walking into their local bank, how much easier is it to close that conversation when you can say, not only will they fund you in 48 hours based on your current cash flow, but when your loan closes, it will automatically feed 50 families in need.
It's a huge selling point. It reframes the transaction from a necessary financial burden into a mechanism for community support.
It gives the business owner permission to feel good about taking on debt.
Exactly.
So, what does this all mean for you, the listener, if you are navigating this space? We set out today to find the actual ground-level advantages of routing your leads to ROK Financial or Lexington Capital Holdings, looking past the standard, partner portals.
And what did we find?
We found a highly engineered, three-pronged ecosystem designed to protect and maximize your referrals.
First, they provide an exhaustive structural menu. From Lexington's flexible LexLock revolving lines to ROK's 90-day accounts receivable factoring and those massive commercial real estate lanes, they ensure that virtually no lead an affiliate acquires is wasted due to a lack of product fit.
Right. And second, they utilize cash flow velocity underwriting. By looking at the speedometer instead of the permanent record really in there, funding businesses with just 6 months of history, 10,000 in monthly sales, and a 500 credit score, they give an affiliate the power to monetize a massive segment of the market that traditional banks have entirely abandoned.
And they do it in a matter of days.
Yes, days.
And third, they backstop the inherent risks of automated speed with a fiercely loyal human support infrastructure. Whether it's Lexington's get-it-done crew dragging an exhausted client across the finish line of an SBA application, or ROK's advisors providing insightful expansion strategies, they actively protect the affiliate's most valuable long-term asset, which is their brand reputation.
It is essentially the perfect back-end engine for a referral partner. You focus entirely on acquiring the lead, and they provide the specialized lanes, the speed, and the humanity to close the deal and make everyone look like a genius in the process.
It really is a highly refined machine. But there is one final, larger implication I want you to mull over, looking closely at how these two companies choose to present themselves to the market. We noted earlier that ROK has fundamentally tied their capital growth to charitable giving, donating 50 meals per transaction.
Right.
And Lexington places the Lexington Foundation right alongside their core loan products and their navigation bar.
They're placing philanthropy on the exact same visual tier as their revenue-generating products.
Exactly, which is deeply telling about where the alternative finance industry is heading. As the space gets more and more crowded, and as the underlying capital becomes increasingly commoditized with everyone offering similar rates and similar speeds, a new differentiator has to emerge.
Yeah, that makes sense.
So the question is, will an affiliate's ultimate deciding factor eventually shift away from who has the marginally best underwriting terms and move entirely toward who has the most profound community impact?
Oh, wow. That is a fascinating thought to chew on. Will the future routing of B2B capital ultimately be dictated by which lender feeds the most people? I love that. Well, that is all the time we have for today. Thank you so much for joining us on this deep dive. Keep asking questions, keep exploring the material, and we will catch you next time.